Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Today is August the 17th, 2023. It's 2:55 p.m. Central Time, and you have just over an hour left in the mortgage-backed security and bond trading day. And we're going to take a look here right now and find out, why does the 10-year Treasury really matter when it comes to home loan interest rates, and where is it right now, and where are we hoping that it will go? Okay, so we got to take a look at that, because today, one of the main articles coming out here in CBC is the 10-year Treasury yield now rises to its highest level since October of 2022. Now, if you follow this show, you will actually know that to be the case, because if we look at our chart here for the 10-year Treasury that we look at almost every single day, we can open this up, push it back a full year, and you're going to see that we were actually a little bit higher than where we are right now back here in October of 2022. And we were just talking about that the other day. Now, where was it that it peaked out? It was right up here at about that 4.32 number, the highest that it went to. Actually, right now, that Fibonacci is 4.335. Where are we right now on the 10-year Treasury? 4.29. Okay. Now, also, you see here that we're down 14 basis points on our mortgage-backed security. We're going to pull that chart up here and take a look where we are there. Again, we just continue to show the price of the mortgage-backed security dropping, which means the yield has to go up. Whenever you see this chart going down, home loan interest rates are going up. So why is it that the 10-year Treasury matters to us? All right. So again, mortgage-backed securities and home loans actually are tied to bonds. Okay, a lot of people don't know that. They, oh well, Fannie Mae owns my loan, or Bank of America owns my loan, or probably not. Okay, the person who sends you the bill, or the company that sends you the bill, if you get a bill from, Ocwen, or New Res, or Mr. Cooper, Bank of America, Wells Fargo, United Wholesale, it doesn't matter really who is sending you that bill. They are called a servicer. Okay, so the billing company is called the servicer. The actual entity that owns your home loan, the paper, the note that actually has that asset, is not is usually not the same entity that is billing you. Okay, so the servicer and the owner are usually two different things. Now, if you have a standard conventional everyday home loan that was under conventional guidelines, in almost all cases, that loan eventually gets packaged up with thousands of other loans and makes a very large mortgage pool, what they call a pool, which is an asset, and that is sold. Usually, the biggest buyer of all home loan assets is Fannie Mae and Freddie Mac. The reason that those entities exist is to create liquidity. They need to buy the loans from those companies that write loans in order to put money back into the companies that write loans to go get more loans. Okay. So if I'm a bank and I have $1 million, well, once I've done $1 million in loans, I've put that $1 million out there. Now I don't have any more money. I don't have any more money to lend. Now, I may be getting the interest, but what I need is more money to do more loans. Okay, because they make money doing the loans as well as on the interest that is accruing on those loans. So what I would do is I would take those mortgages that are notes, they're pieces of paper. Somebody owes me 100,000, someone owes me 250, someone owes me 350. You add it all together with all the notes that I have, and I have $1 million in notes. I can take that $1 million in notes and sell that to Fannie Mae, for instance, hypothetical, and now Fannie Mae gives me my $1 million back, and now I can do $1 million in loans again. And I make money on the fees of securing those home loans. I sell the loans to Fannie Mae and Freddie Mac and anybody else that is actually buying mortgage-backed securities, and then they're the ones who actually get the interest on that note. So whoever owns the note is who gets the interest. But doing home loans creates revenue in other ways that I don't have enough time to get into right now. But one of the types of revenue that is created by owning a home loan is that you need someone to service that loan, someone to do the billing. You're probably not getting a bill from Fannie Mae or Freddie Mac. They have someone who is doing the servicing for them. That's called a servicer, the billing company. Okay. Now, billing companies don't do it for free. They charge for that. Okay. So there's what's called a mortgage servicing premium. So there is a cost associated with a note the loan because somebody is going to get paid for servicing that loan. All right. So there's revenue that is in that asset. Now, when you have a 10-year treasury, it's not necessarily being serviced. There's not revenue in the servicing end of a treasury. So there's a different source of revenue when it comes to mortgage-backed security bonds. And there's also a difference in risk. Okay, so if you put your money into the bond called a mortgage-backed security, there's probably a higher propensity that there may be a default on that debt, on that repayment of that debt, than if it was the U.S. government on like a 10-year Treasury bond or a 30-year Treasury U.S. Treasury bond, something like that. So there's less risk with the government than there is with a mortgage-backed security. How do you then sell a mortgage-backed security? You offer a higher rate of interest, a higher rate of return, which is why you would take on that additional risk. Now, how long does somebody usually keep a home loan? Okay, so people say, oh, I got a 30-year fix. Okay, that's great. But normally, and I'm talking like way normally, people do not keep their home loan for 30 years. They used to, but they don't usually do that anymore because they either refinance or they sell and move. Okay, so especially for the past 10, 15 years, refinance to a 5, refinance to a 4, refinance to a 3, refinance to a 2. These are all refinances, which means that that loan got paid off. So whoever bought that loan because they wanted the interest on that loan. Say I bought a $100,000 loan with a 4% interest rate and I held on to it and I was making my 4% for 2, 3, 4 years. But then the the person who has that debt goes and gets a refinance loan with someone else at 2%. Well, they're paying me off. So my 4% loan has been paid off. I got my money back, but I no longer get that revenue, that 4% revenue, because that person, the homeowner, found a lower rate of interest somewhere else. Okay, so there's a lot that goes into it. But the point is that usually you only keep a home loan between somewhere like 8 and 10 years. That's the average. Okay, so who does that compete with really as far as rate of return? How long am I going to get my interest? It doesn't really compete with a 30-year US Treasury bond because people don't usually keep their home loan for 30 years. Excuse me. I am not going to start this recording over here. So if you have an 8-year, 10-year lifespan of a mortgage-backed security or a mortgage debt, it competes with the US 10-year Treasury bond. So that is why we always talk about the 10-year because it competes with that 10-year. Now, I mentioned earlier that there is a higher number, a higher amount of risk when it comes to a mortgage-backed security from a 10-year treasury because this is backed by the United States government, US Treasury bond, okay? So if they're offering a 4.28 as far as the yield, so that's the rate of interest basically that you're going to get paid if you were to go buy a 10-year treasury today. 4.282. Normally, the cost for the additional risk is usually about 1.8% higher, which means that a normal 30-year fixed mortgage would usually be at about 1.8% higher than the going rate for a 10-year US Treasury bond. All right. Now, right now, you can see that it is quite a bit higher. Right now, I'm going to pull the rates up here in just a minute, and you're going to see, let's go ahead and do that right now. We are going to pull up a very well qualified 30-year fixed conventional home loan. This is somebody who has excellent debt, excellent credit, and has a large down payment. They're at 4.5% with a credit back to them of $454 with the loan store. And if they were to put a point down, I mean, they're only getting to about 7.125. Okay, so essentially, let's just say that it's 7.25. We're going to go in the middle here. That's with about a half of a point in cost. All right. So if it's 7.25, you're writing about 3% over the 10-year treasury. That is not normal. It is not normal to ride 3% over the 10-year treasury. Now, here's something interesting as to why that would be the case. If you're going to buy a mortgage-backed security or a bond of that sort, you are expecting to have that for a long enough time to kind of recoup your investment. Usually, again, it's not going to get paid off between 7 to 10 years. But again, these things get traded back and forth. So they understand they may only actually reap the rewards of that interest on a monthly payment for, let's say, 3 or 4 years. All right. Now, right now, people understand and the investment community understands that when you're writing home loans at 7.5, 7.25, 7.38%, as soon as rates go down, somebody who has a rate at a loan at that rate is going to refinance. Okay, so there is a like an incoming refinance boom. I don't know how big of a boom it's going to be in comparison to some that we've seen in the past 20 years, but there's a lot of people that are buying houses today in the sixes, sevens, and eights. That what are they going to do when rates are in the fives, fours, and maybe even threes? They're going to refinance. So the person, and we're talking about the investor that bought a mortgage-backed security pool of $100 million in home loans at an average interest rate of 7.5%, like today, they highly expect that they will not have that asset in the same format for very long because it is going to get paid off early. People are going to refinance as soon as they can, which means that that asset is less valuable today than an asset that was, say, maybe a mortgage-backed security that's closer to 4%. They say, look, there may be some options, rates may fluctuate up and down, but a lot of people probably aren't going to go refinance to get a 0.5% lower interest rate, or even one. But when you're talking 2.5%, I mean, it's going to happen. So the expectation, what I'm telling you is the expectation that home loan interest rates are going to come down in the near future is even seen within the investment pool, to the point that they won't even buy a home loan without a premium added on top of the 10-year Treasury, which right now is somewhere between 1 and 1.5% extra, because they expect that their asset will not be around for very long. Now, I know that's a lot of information, but I want to make sure you understand there are reasons for what's going on and why the 10-year Treasury matters. Let me know what you think. If you have any questions, if you want more information on that, I'll try to explain, but I try to keep this down to not being as long as it is today. Good information though for you. Make sure that you like, subscribe, share, hit the notification bell on the bottom, and let me know your thoughts. I'll get back to you again tomorrow. Have a great day.